Hey everyone, and welcome. I am absolutely thrilled to have you here for today's explainer. We are going to tackle a really massive financial misconception today, and that is the hidden danger of keeping all your hard-earned money just sitting there in a traditional savings account. We're going to completely unpack this illusion of safe savings, and more importantly, I'm going to walk you through a super practical, step-by-step solution called the bucket strategy. Let's jump right in.
So, I want you to ask yourself honestly right now, is your money actually safe in the bank? I mean, on the surface, the bank offers a huge advantage, right? Liquidity, your money is safe from theft, you can grab it for emergencies, and it feels secure. But here's the catch. Keeping the bulk of your money completely idle creates this invisible, silent loss. You are completely missing out on the incredible power of compounding, which is literally the true engine of wealth creation.
Here is a quick look at our roadmap for today. First, we'll cover the silent thief called inflation. Second, your core investment options. Third, the three-bucket strategy. Fourth, some real-world portfolio examples. And finally, we'll wrap up with the ultimate wealth rule.
Okay, let's dive into our very first topic, the silent thief called inflation. Let's just look at the raw math behind a standard savings account. Say you've got 10 lakh rupees. If you leave that 10 lakh in a savings account earning a pretty typical 2.5% interest rate, you're making about 25,000 rupees in a year. Fast forward 5 years, based on a simple illustration, and you've earned roughly 1.25 lakh rupees in pure interest. The balance is going up, so it feels like you're winning, doesn't it? Well, here comes the harsh reality check. Enter the silent thief, inflation. While your savings account is crawling upward at 2.5%, the average inflation rate might be hovering right around 5 to 6%. What does that actually mean? It means the cost of living is rising twice as fast as your money is growing. So sure, the numbers in your bank account might be getting slightly larger, but your purchasing power, what that money can actually buy you out in the real world, is quietly being destroyed day by day. To put that into perspective, imagine you want to buy a car today that costs exactly 10 lakh rupees. If you apply that fixed percent average inflation rate, in 10 years, that exact same car is not going to cost 10 lakh anymore. It's going to cost roughly 17.9 lakh rupees. So you see, the real question isn't whether your 10 lakh is safe. The real question is, what will your 10 lakh actually buy in the future? Moving right along to part 2, your core investment options. Let's start with a really simple, direct comparison right within the banking system itself. If you absolutely don't want to take on market risks, fixed deposits or FDs are your next step up. If we look at the RBI's July 2026 data, term deposits over 1 year were roughly in the 6.00 to 6.75% range. So if you put that same 10 lakh into an FD at 6.5%, you earn approximately 65,000 rupees in a year. Compared to the 25,000 from the savings account, that's an instant 40,000 rupee upgrade every single year. Just a quick reminder though, FD interest can be taxable, so always consider your post-tax returns. Now, stepping beyond the bank, we have the Public Provident Fund, or PPF. This is an absolutely fantastic tool for conservative investors who are looking for safe, government-backed, long-term growth. For example, if you were to invest 1.5 lakh rupees every single year into a PPF, assuming an illustrative 7% annual return, over 15 years, you would have invested a total of 22.5 lakh. But thanks to the magic of compounding, its future value grows to roughly 37.9 lakh rupees. The really crucial point here, though, is that PPF is locked in. It is not instantly accessible like a savings account. It is strictly for your long-term bucket. All right, now for pure wealth creation over a 10 to 20-year horizon, we have to talk about diversified equity mutual funds. The growth potential here is just massive. If you set up a systematic investment plan, an SIP, of 10,000 rupees a month for 20 years, your total out-of-pocket investment is 24 lakh. But if we assume a hypothetical average return of 12% annually, that amount can snowball to approximately 1 crore rupees at the end of 20 years. But please listen closely. That 12% is absolutely not guaranteed. The market can and totally will fluctuate. Your portfolio might temporarily drop by 20 to 40%. And that right there is exactly why equity funds must only be used for money you know you won't need for a very long time. Which brings us perfectly to part 3, the 3-bucket strategy. This is how you completely stop guessing and start structuring your wealth. It's brilliant because you just divide your money based on when you actually need it. Step 1 is your green bucket. This is your emergency fund. It needs to cover 6 to 12 months of living expenses and belongs in a savings account or a liquid FD. Its job isn't to make you rich. Its job is to be available instantly when life happens. Step 2 is your yellow bucket. This is medium-term money you'll need in 1 to 5 years. Think FDs or short-term debt instruments. And step 3 is your blue bucket. This is the long-term money you won't touch for 10 or more years. This is where you really let compounding do its thing through diversified equity mutual funds and your PPF. Let's actually see this in action in Part 4, Real-World Portfolio Examples. Let's analyze a sample 20 lakh rupee portfolio. If we take the wrong approach, that means putting all 20 lakhs straight into savings. Sure, you have incredible liquidity, but as we just saw, inflation will literally eat it alive. Long-term growth is basically zero. Then there's the conservative approach. Maybe 5 lakh in savings and FDs, 12 lakh in PPF and debt, and just 3 lakh in equity. This definitely keeps your risk super low, but the growth is only going to be moderate. Finally, the long-term growth approach. This assumes your emergency fund is totally sorted and this money is for 10 or more years down the line. Here, you might keep 3 lakh in FDs, 3 lakh in PPF, a hefty 12 lakh in diversified equity mutual funds, and maybe 2 lakh in gold for a bit of diversification. Yes, this brings higher market risk, but it also brings massive, massive upside potential. And how does this actually play out on a monthly basis? Well, if you are a high earner investing, say, 50,000 rupees a month, your allocation could look something like this. You send 10,000 straight into your emergency FD bucket. Another 10,000 goes into a safe PPF bucket. The largest chunk, 25,000, gets channeled into equity mutual funds for that aggressive compounding. Finally, 5,000 goes into gold, which is great for theoretical diversification. Quick tip though, you might want to look at alternatives to physical jewelry so you avoid paying making charges. And the best part, once your emergency green bucket is totally full, you can just shift that 10,000 right over into your long-term blue bucket investments. Now for the big takeaway, Part 5, the ultimate wealth rule. The absolute ultimate rule of personal wealth comes down to this. The bank is a place to keep money, investment is a strategy to grow money. Once you realize this, it changes everything. You don't abandon the bank. It is totally essential for your green bucket, your emergency cash, but you absolutely cannot rely on it to secure your financial future against inflation. You have to invest to grow. But I need to give you a really stern warning before you start investing. Do not let the desire to beat inflation push you into dangerous territory. You have to avoid these wealth traps at all costs. If you see some unknown scheme promising a guaranteed 15 to 20% return, run the other way. There's no such thing. Stay away from chit funds, unregulated apps, or just blindly copying someone else's personal investment plan. Chasing the highest return is so often just a mask for the highest chance of losing absolutely everything. Stick to regulated, proven instruments like the ones we've broken down today. I want to leave you with this final provocative thought. Take a look at your savings right now. What will your 10 lakhs true purchasing power actually be in 10 years? Is it going to buy the whole car, or is it just going to buy the tires? Financial planning isn't just some one-size-fits-all formula. It depends entirely on your age, your income, and your specific life goals. But if you know exactly how much you have, what you can comfortably invest every month, and your timeline, you can calculate the exact portfolio you need to defeat that silent thief. Thank you so much for joining me on this explainer. Keep learning, stay focused, and go start filling those buckets.